Well, folks, pull up a chair. I'm an old man now, 94 years young, and I've seen a thing or two in markets and in life. You know, people often ask me about the secret to investing or how to get rich. And the truth is, it's not some fancy calculus or insider tip. It's usually about avoiding really dumb mistakes and having a fair bit of patience. And believe me, I've made my share of dumb mistakes. What a bonehead I was sometimes. One of my earliest and certainly most persistent errors was buying into Berkshire Hathaway in the first place. Now, I know what you're thinking. Warren, that's what made you rich. And yes, it did eventually, but it was a long, painful detour from where I should have been. Back in 1962, I started buying shares of Berkshire, then just a textile company up in New Bedford, Massachusetts. My thinking was simple, or so I thought. The company was buying back its own shares at a price I thought was undervalued, and I figured I could make a quick profit from a small arbitrage play. The stock was trading around $7 or $8 a share. It looked cheap. I remember a specific incident with Seabury Stanton, the CBO at the time. He offered to buy my shares back at a certain price. I agreed. Then he came back with an offer that was a fraction of a cent less than what we discussed. A tiny amount, really, but it stuck in my craw. It felt like he was trying to chisel me, and my competitive spirit, which can sometimes be my worst enemy, flared up. Instead of just selling and taking my small profit, I got mad. I started buying more shares with the sole intention of gaining control of the company and firing Mr. Stanton. What a foolish emotional decision that was. I ended up pouring more and more of my partnership's capital into buying out the other shareholders, eventually gaining control in 1965. By then, I'd paid an average of about 14.86 per share to get control of a textile mill that was already a dying business. Every dollar I put into those old looms and spindles was a dollar that wasn't going in something truly wonderful. We tried, Lord knows we tried, to make a go of the textile operations for another 2 decades, investing more money, bringing in new management. But it was like trying to push water uphill. The underlying economics were terrible. It was a commodity business, capital intensive, with no competitive advantage. What I learned from that long, drawn out mistake, and Charlie Munger, my partner, certainly hammered it home, is that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I had bought a terrible business at what looked like a wonderful price, and the wonderful price turned out to be a trap. That initial emotional decision, fueled by spite over a few cents, cost me, and by extension, our shareholders, billions in opportunity cost over the decades. Had I put that capital into a good business from the start, imagine the compounding. Charlie always says, it's like having a choice between an old broken down car and a brand new Ferrari, but you pick the broken car because it's cheap. My dad taught me a lot about integrity and honest dealing, but he never taught me to let anger guide my investment decisions. That was a lesson I had to learn the hard way. Here's the deal. Ben Graham, my old professor at Columbia, taught me the concept of cigar butt investing. That's where you find a company that's so cheap, it's like finding a discarded cigar butt on the street that still has one puff left in it. You pick it up, take that last puff, and discard it. That's what Berkshire Hathaway, the textile mill, was. It was cheap, had some assets, but no future. It taught me about the difference between price and value. Price is what you pay, value is what you get. With Berkshire Textiles, I paid a low price, but I got very little enduring value. Charlie helped me evolve from a Graham-style cigar butt investor to one who looked for enduring quality. He taught me that it's smarter to pay a fair price for a great business that can earn high returns on capital year after year with management that understands how to reinvest those earnings wisely. You want a business with a wide, durable moat around it, protecting its economic castle from invaders. A moat could be a strong brand, a patent, a cost advantage, a unique distribution system, or a high switching cost for customers. The textile business had no moat. It was a castle with no walls. Let me give you a better example, one that truly illustrates the power of a moat. See's Candies. We bought See's in 1972 for about $25 million. It was generating about $4 million in pre-tax earnings at the time. Now, Charlie and I, we saw something different there. We saw a business that made people happy. A box of See's isn't just candy, it's a gift, a tradition, a memory. It had pricing power. If See's raises its prices a little, people don't stop buying it for Mother's Day or Christmas. They just grumble a bit and pay it because the emotional value is so high. That's a moat, that's a brand. Over the years, See's had generated well over $2 billion in pre-tax earnings for Berkshire, far more than its original purchase price, and it required very little capital to grow. It wasn't a capital-intensive business like a textile mill. It poured out cash, which we could then reinvest elsewhere. That's the beauty of a wonderful business. It compounds value effortlessly. You don't have to work hard to keep it afloat. It floats itself thanks to that wide moat. It just keeps smiling and generating cash. Or take Coca-Cola. When we bought into Coca-Cola in 1988, we invested $1.82 billion. People thought it was crazy that it was a mature business. But what is Coca-Cola? It's a simple, universally loved product with an unrivaled distribution system and a brand that evokes happiness and refreshment all over the globe. It's the ultimate example of a company with a wide moat based on brand and distribution. Think about it. 1 billion people around the world choose Coke, often without even thinking. The taste memory, that ingrained preference, is incredibly powerful. We still hold Coca-Cola. It's been a fantastic investment, multiplying our initial outlay many times over. The earnings have grown, the dividends have flowed, and the brand has endured. It's not about inventing some new technology. It's about selling a simple product that people love consistently everywhere. This is the kind of business Charlie taught me to look for: simple, enduring, with a wide, deep moat. You don't need fancy math to understand a company like Coca-Cola or See's. You just need common sense. If you're a young investor today, the single most important thing you can do is to understand what you own. Don't buy a stock because someone on the internet told you to or because it's hot. Buy a piece of a business that you understand, a business whose economics you can comprehend. Ask yourself what the business is really worth. Its intrinsic value based on its future earning power, and then buy it for less than that. That difference is your margin of safety. A concept Ben Graham hammered into me. It protects you from the unexpected. You don't need to do extraordinary things to get extraordinary results in investing. You just need to do ordinary things extraordinarily consistently. That means being patient, waiting for the right pitch, and understanding that the market is there to serve you, not instruct you. Mr. Market is a manic, depressive fellow who shows up at your door every day offering to buy or sell your shares. On some days, he's euphoric and will offer you a high price. On others, he's depressed and will offer you a ridiculously low price. You don't have to trade with him. You can ignore him. You'll wait for him to be irrational in your favor. I spend 80% of my day reading annual reports, 10Ks, newspapers, trade journals. It's how I absorb information, how I expand my understanding of different businesses. It's not about finding some secret formula, but about building up a reservoir of knowledge about how businesses work, what makes them tick, what creates value. It's like a baseball player constantly studying the opposing pitcher. The more you know, the better your chances of hitting a home run or at least getting on base. This philosophy applies to any business, not just investing in publicly traded stocks. What really matters in business is finding something that provides enduring value to customers, something that can survive competition, and something that can generate cash without constant infusions of capital. We look for companies where we trust the management, of course, but even more importantly, we look for businesses so wonderful that an idiot could run them, because eventually one will. That's a bit of self-deprecating humor, you see, because I've probably been that idiot more than once myself. You know, the temptation to stray outside your circle of competence is always there. Everyone thinks they can understand something new, something complicated if they just read enough or talk to the right people. But sometimes what you don't do is as important as what you do. I've always tried to stick to businesses I can understand. I don't invest in tech companies for the most part because I don't really get how they'll evolve over time. It's not because they're bad businesses, it's because I'm not smart enough to handicap them reliably. But that's not the only lesson I learned the hard way. Sticking with simple, understandable businesses with strong moats became the core principle. Yet, even with that firmly in mind, I still managed to make another multi-billion-dollar blunder, one that serves as a stark reminder that competitive advantages aren't static. This reminds me of another time when I was fooled by a business that seemed simple enough, a business I thought I understood. The next mistake in some ways cost Berkshire even more dearly than the textile mills because it involved giving away our own precious stock. Back in the early 1990s, specifically 1993, I made what I've called the most expensive shoe purchase in history. We acquired Dexter Shoes, a shoe manufacturer in Maine. At the time, Dexter looked like a solid, traditional American business. It had a good reputation, a loyal customer base, and seemed reasonably priced. It was in an industry I thought I understood, having grown up watching my dad run his brokerage during the Depression. Seeing how these classic American companies operate, I figured we could grow it steadily. A good old-fashioned American enterprise. I was dumb enough to pay for Dexter Shoes with Berkshire Hathaway stock. Now, Charlie and I, we are extremely reluctant to issue Berkshire stock for acquisitions. It's like selling a piece of our crown jewels. But I like Dexter, and the owners wanted stock, so I agreed. We issued 25 to 203 shares of Berkshire stock for the company. What a bonehead move that was. I totally missed the impending threat from foreign competition, the way the shoe industry would be commoditized by cheap imports, and how rapidly their brand would lose its footing. Dexter Shoes quickly became worthless. And we tried everything, but the economics were just impossible. The company lost money year after year. By 2000, we wrote off the entire investment. But the real cost wasn't just the $43 million goodwill write-off. The real cost was the Berkshire stock I had issued. Those 25,203 shares, compounded over the years, are now worth many, many billions of dollars, probably over 20 billion today. That's the true cost of that mistake. It was an irreversible error, giving away a slice of a truly wonderful business for a piece of a truly terrible one. What I learned from Dexter, and what Charlie reminds me of often, is that moats can erode, sometimes faster than you think. What looks like a competitive advantage today might be gone tomorrow, especially in industries exposed to global competition without a truly unique selling proposition. The Made in America label wasn't enough to protect Dexter from lower cost producers overseas, and they didn't have a brand like Nike or a distribution system like Foot Locker to fall back on. Their moat was an illusion. It emphasized again that intrinsic value isn't just about current earnings, it's about the durability and predictability of future earnings. This lesson made us even more careful about understanding the underlying economics of a business, not just its current profitability. It's why we love a business like Geico, for instance. We've owned Geico for decades, starting with a minority stake in 1951, buying the rest in 19. Geico has a permanent cost advantage. They sell directly to the customer, cutting out the agent commissions. That's a powerful, sustainable moat that translates directly into lower prices for customers and higher profits for us. It's simple, it works, and it endures. Or consider our investment in Apple, which might seem like I'm breaking my own rule about not understanding tech. But our investment in Apple wasn't about understanding the technology behind the iPhone. It was about understanding the consumer behavior, the ecosystem, and the incredible customer loyalty. People don't just buy an iPhone, they buy into the Apple experience. They're locked into the ecosystem, and they love the brand. It's like a utility in their lives. That's a massive, durable moat. Charlie helped me see that It was more of a consumer product company than a tech company in the traditional sense, and that clicked. It makes perfect sense in terms of enduring customer relationships and pricing power, which are things I do understand. So if you want practical wisdom for investing, here's some of it. Stick to your circle of competence. Don't invest in businesses that are outside of what you genuinely understand. And if you're unsure, just don't do it. There's no prize for constant activity. In investing, unlike baseball, you don't get called out for not swinging. You can let thousands of pitches go by. You only need to swing when you get a fat pitch right over the plate, one you know you can hit. The vast majority of my success has come from inaction. Avoid complexity like the plague. If a business plan can't be explained in simple terms, if it relies on complex financial instruments or abstract ideas, then it's probably not a good business. The best businesses are often the simplest ones, the ones that solve basic human needs or desires in a superior way. Think about See's Candies, Coca-Cola, or even Dairy Queen. Simple, easy to understand, and consistently profitable. This brings me to broader business principles. What really matters in business is human nature. Fear and greed are powerful forces, and they drive the market to irrational extremes. Your job is to ignore the noise, ignore the crowd, and think for yourself. Be fearful when others are greedy, and greedy when others are fearful. It sounds simple, but it's incredibly hard to do when everyone around you is panicking or getting rich quick. It requires an emotional discipline that is far more valuable than a high IQ. And never ever get into significant debt for investing. My dad taught me that lesson early on. He saw what debt could do to people during the Depression. Using leverage amplifies both gains and losses. If you're brilliant, you don't need it. If you're dumb, it's going to kill you. I've never borrowed a significant amount of money to invest. The chance of ruin, no matter how small, is unacceptable. Sleep well at night. Over at Berkshire, we've always emphasized long-term thinking. Our favorite holding period is forever. When you buy a wonderful business, why would you ever want to sell it? You just let compound interest, the eighth wonder of the world, do its work. It's like planting a tree. You don't dig it up every few months to check if the roots are growing. You plant it, water it, and let it grow. You let time be your friend. A shareholder once asked me at our annual meeting, one of those wonderful gatherings in Omaha where 40,000 people come to learn and laugh, what was the best advice I ever got? And I always come back to what Ben Graham told me. Always consider a stock as a part of a business and judge its performance by the operating results of the company. It's not a ticker symbol. It's a real business with real assets, real customers, and real people working there. Another point often overlooked is the importance of having great people around you. Charlie Munger, Ajit Jain running our insurance operations, Greg Abel overseeing our non-insurance businesses. They're all brilliant. Surrounding yourself with people who are smarter than you, who think differently, and who are honest and ethical is one of the best investments you can make. It forces you to think clearer and keeps your ego in check. Charlie especially has an incredible ability to clarify my thinking, often with just a few well-placed words. My dad ran a stock brokerage during the Depression, and I remember delivering newspapers as a kid, saving every penny. I bought my first stock, City Service Preferred, at age 11 for $38 a share. It went down to $27, then back up. I sold it for a small profit. Then it soared. I learned about patience and about the folly of selling too soon early on, filing my first tax return at age 13, claiming a $35 deduction for my bike. That was a real proud moment. These early experiences shaped my appreciation for the power of saving and investing early. After all these years, after all the ups and downs, the triumphs and the blunders, here's what I know for certain. Investing doesn't need to be complicated. It's really quite simple. If you approach it with the right mindset, you don't need fancy math, you don't need inside information, and you certainly don't need to listen to the talking heads on television. What you need is a sound framework for making decisions, a deep understanding of human nature, and a whole lot of patience.
I'm 94 now, and if I could tell young investors one thing, it would be this: focus on building your human capital first. Invest in yourself. Read voraciously. learn constantly, sharpen your skills. That's the best investment you can ever make. And when it comes to financial capital, think of owning a business, not just trading pieces of paper. Buy businesses you understand with enduring competitive advantages, run by honest and capable people, and buy them at a fair price with a margin of safety. Then just sit on them for decades.
I'd never bet against America. The ingenuity, the resilience, the free market system, it's a phenomenal engine for progress and prosperity. There will be bumps in the road, there always are, but over the long arc of history, betting on America has always been a winning hand. So be optimistic, be patient, and remember the market is usually rational in the long run, but it can be absolutely crazy in the short run. Don't let the short-term craziness distract you from the long-term truth. You don't need to be brilliant. You don't need inside information. You just need to be rational and disciplined. And don't forget to enjoy the journey. And still live in the same house I bought in Omaha in 1955 for $31,500. I drive myself to the office every day. I eat what I like, often a cherry Coke and some Say's peanut brittle, and play bridge with friends like Bill Gates. It's a pretty good life, one built on simple principles, hard work, and learning from every mistake, especially the dumb ones.